Today's number is 5,000. JP Morgan and Goldman Sachs are upgrading one of our favorite trades once again, but should that be a cause for concern? In today's video, we take a look at how these metals are performing and why people are starting to lose faith in the fiat system. On top of that, could we see problems on the horizon when it comes to a dull market and the S&P 500 into the jobs report? Well, we've gone and broken down what exactly is going on with the trends, and we'll be sharing it with you in the video. And along with all of that, it looks like the bonds market has started to wake up. The MOVE index is blowing up, and it's because volatility is back. The worst month of the year is upon us. Will it be one once again? Join us as we cover stocks, commodities, and cryptos in detail right now. Well, welcome back everybody to The Daily Show. My name's Thomas Atkinson, and as always, we're going to discuss with you today the latest in the macro, the big data, and of course, what exactly is going on with the options flow information coming into this big jobs numbers. As we've often said, the big thing with the jobs numbers is not necessarily the number themselves, but it's the revisions. And this time, it's going to be about following yields. But in light of that, are we seeing too much bullishness in the Holy Trinity? Now, I often call silver, gold, and Bitcoin as being very decent hedges against the current problems we have in the currency markets. But according to Goldman Sachs and JP Morgan, they've come out with a new call and they believe it could be going towards 5,000. Now, as you guys know, I've been very bullish and a lot of you have been on gold, but it always worries me when everyone jumps on board the bull wagon. And of course, this is a fairly easy technical to spot on the charts. As you guys can see here, we did a write-up over on our X account. Links in the description down below if you want to follow over there. And we've seen in the past movement here, a huge move in gold, a very nice symmetrical triangle when attached to this type of move could be a pennant. And of course, this gives us some pretty good targets. 4,000 to 4,200 seems to be a level that we think it could get to even on the macro scale as central banks buy gold. And of course, everybody moves towards a potential of a fiat breakdown. On top of that, though, you've also got 3,750, but it is still a concern that everyone's now starting to make these lofty calls. I've seen 7,000, 10,000, 5,000, and of course, our maybe more conservative goal here of 4,000 being mentioned several times over on the different social medias. Now, is this normal? Well, the answer is quite simply yes. You can see here Charlie Bilello's latest data here going back over gold annual returns. We are on track for one of the best ever. And it does bring me back to several other periods where gold has had some great runs. Now, remember those times in the 70s, the stagflationary period? Well, we're running similar to those. We're also running similar to periods that we saw before great financial collapses. And in interestingly, perspective, I guess, here is that I think gold could still have more in it just when you look at the current trends. If you have a look here at the blow-offs, this was a 4-year run before it started to find problems. Over here in the 2000s, it had even more than 4 years of some epic runs. And here it also managed to achieve 4 years. So yes, you might say, well, 2022, Tom, it's slightly up. But I would say that this kind of bodes well when you're starting to think about gold into 2026. I recently asked you guys what you thought, and a lot of you had anywhere targets from 3,800 to the 4,000s, with some of you actually going as bold as 10K when you were starting to talk about gold. So it's clear that a lot of people are bullish, but that may not be such a bad thing if the market continues to show the flows. Remember, I do say if it's in the press, it's in the price, but at the same time, the market still is showing, at least on the higher timeframes, the weekly and the monthly, a very bullish momentum move. And another thing that could be kind of good, or maybe not so good for the economy, but good for gold and silver, is that we're starting to see inflation spiking back up again. You can see here, according to Ryan Detrick, and I think it's Sonos, we have some data here to do with the idea of inflation. Now, inflation is actually not narrowing anymore. If you take a look here at the previous years, let's say 2024, you can see 28% of the items with inflation below 0%. So it was, a decent amount, but not that much. 40% of items had inflation above 3%, and the middle was kind of there. Now we're getting a more drastic kind of tale of two stories. 31% of items are now below 0%, and 45% are now showing inflation above 3%. So we've actually seen an uptick in overall items showing inflation above 3% in 2025. Now, this could be a problem because it could take us into a stagflationary period where the Federal Reserve starts to do rate cuts, and at the same time, we're starting to see inflation. And if we see low growth in the economy, then that's going to put us into what we call the stagflation quadrant, or even worse, some kind of financial crisis. Now, it's not time to worry about those things yet because, of course, we haven't seen signs in the bonds or debt market showing up, and we'll be one of the first, I believe, on the internet to find this if it does actually occur. But we have started to see a little bit of a move in the MOVE index. So basically, this really is showing us here that we have kind of the options implied volatility for at least the next 30 days spiking up. And the last time we saw spikes like this were, of course, back in the April period. Now, Jim Bianco has actually gone through and found the 2-day rate of change is one of the highest levels that we've had in months. So it kind of suggests that a lot of people are banking on extreme volatility during the next maybe month to 2 months. And in particular, of course, that makes sense because if you've done your analysis on September, not only do we have the jobs numbers coming out in less than 24 hours, but then we have probably an interest rate cut from the Fed. And often around an interest rate cut, we can get some extreme volatility. Remember, it's a coin flip whether the market's up or down, and you during those periods for the first month. And you might say, well, a coin flip, that's not very good to go off. Well, the thing about a coin flip is that the markets are actually more than a coin flip in the bullish direction. So when you start to say coin flips and you look at a lot of volatility coming through, it's actually more towards the bearish signs than you could think of during that particular month. But either way, do we actually think the markets can fall? Well, the problem is they don't seem to be able to. Every time the market comes to even a minor support, like we saw this week, what happens? Everyone goes and buys puts. You can see here puts sparked to the highest level in 5 years. And these are a lot of short-dated puts as well over that fall last week. And that kind of makes you start to wonder, well, can we actually fall again? Not if everybody is trying to stack on puts. So while volatility underneath the hood is spiking because people are concerned about these future macro events, at the same time, you can see here that we also have put walls appearing. And later on today's video, we'll actually take a look at the 2 big ones for the next 24 hours because boy, oh boy, are they getting massive. So let's now talk about the jobs numbers. We already know that, of course, there are expectations that jobs are going to weaken. And there are many reasons for this. According to the latest Bloomberg data here, it shows that US-based companies announced in August plans to add 1,494 jobs. This is the fewest for the month in data going back to 2009. So this is, of course, a slowdown in the jobs numbers. And I think we're pretty well aware of this, and so is the market. So you might say, well, shouldn't this mean that the market is going to fall off a cliff? Well, the problem with a weakening jobs market is there is one way to support that. And you guessed it, it is the Federal Reserve. And the Federal Reserve can, of course, do rate cuts, and they can come out, and even though they've been doing quantitative easing stealthily for a little while, they can come out and support the markets that way as well. And this is something similar to what we actually saw in 2019, a weakening market coming up to the kind of end of a bull run, but it was being kept afloat by a Federal Reserve switch that then ended up putting us on a track. And again, I actually believe that whether it was the pandemic or something else, we were already seeing a heated market was probably going to get a pullback then, but it was putting us on track for basically that to occur. So when we have a look here at Mike Siccardi's latest report here from Goldman Sachs, you can see here that jobs have been weakening for a while. This is not a new story. We've talked about this quite a lot. But again, macro doesn't show up in stock price like that, guys. It takes a while. So we're bringing these charts to you, but you've got to remember that this actually puts us onto a track of looking at structure more than anything else. If we see small caps, mid caps, hyperbolic stocks, alt cryptocurrencies, all of those things start to go ballistic, that's when everyone's getting all in. Remember, a market cannot truly crash until everybody is all in. And you might think that's happening right now, but it's likely we're going to see a lot more volatility over the next year. And a lot of that is going to have these huge whipsaw swings and things like that as we see more and more people jump into this market, especially on leverage. Now, what about AI? So the problem with jobs numbers is we're seeing it weaken. Now, why is that? Well, have a look here at the latest survey reports here from Goldman Sachs. Again, if we take 250 plus firm size companies, they are adopting AI at a very quick rate. And we're actually seeing the kind of mid-sized companies here, 100 to 250, starting to overtake even the small businesses, which are often ahead of the curve because, of course, that's where the innovation businesses start. And they're actually adopting AI at a very fast rate. We're starting to see real impacts from AI into the workplace. And I know a lot of you guys already know this. You work in the workplaces, you're seeing AI replace certain jobs out there. But have a look here. What is tending to happen since ChatGPT anyway, and the rise of these AI bots, is that people early on in their career, they're getting affected more than anybody else. So, of course, anybody really in that kind of 30 to maybe 50-year bracket, they're not being affected so much based on the latest data here. Whereas, of course, younger people early on in their career or right out of university or college in America, you guys are just struggling. And you see that actually in the unemployment numbers. There's clearly a big disconnect here. And if we start to see, let's say, this segment of the market, developing or mid-career segment start to get hit up by AI, it could be a real turning point for markets. So these are definitely worthwhile tracking, and we, of course, will be doing so. Now, do we know the labor market is, of course, getting weaker? Yes, this is certainly showing it. This is quits here from the US Bureau of Labor Statistics, and it is showing a very concerning trend, which, of course, lines up very well with people starting to feel it on the ground level. I'm interested to know, in your industry, are you seeing something similar? Let us know in the comments down below, guys, because this is just showing up across the board. Jolts change in layoffs and discharges here from Blue Kurtic again. You can see a massive spike up in layoffs and discharges. People are feeling the pinch. And when real total construction spending year-on-year change gets down to these levels, it puts a lot of markets on timers. So again, if the ship cannot be turned, these have been concerning periods. And funnily enough, we saw similar concerns back in, you guessed it, 2019. There's a reason I brought that up because, of course, the Federal Reserve had to support the market. We ended up going into a bear market during that period, of course, albeit for only a few weeks because, of course, of the massive stimulus. But this time, things are bigger. Things could be worse. So you've got to be paying attention to the markets from this macro side. Be aware, but follow the price action. And at the moment, again, the price action does not show significant signs of weakness just yet. Slowing economic momentum, but no sign of recession yet. This is a cool chart here. It's probably their proprietary indicator, but it does tend to show that when this upticks, there's still some lifeblood in the markets. And again, we're looking for this to probably show signs of decline over the next 12 months. But that hasn't happened just yet. So something we might track as well, and that's from Carson Research. Now, where are some concerns? We've often said that the American consumer will show us the way as well. And that is that, of course, we're starting to see some companies starting to have inventory spikes. So Wasteland Capital here has done a bit of a rundown on the latest Lululemon result. If you're not aware, it wasn't that great, and the stock obviously fell off quite a lot. We actually saw America's sales decrease around 4%. Obviously, we can see here that Lululemon's probably under a lot of competition. You know, there are a few brands that are really kind of beating them out on social media now. And of course, we see our earnings shrink. But this was a big story of how great they were doing only a few years ago. And then, of course, we also see inventory increasing. So that could also be that people are just saying, you know what, too expensive, other alternatives. You know what, I'm not going to be buying this anymore. I got to save the money, put it against some debt, put it against credit cards, put it against buying some food at the shops. Who knows? But people are starting to feel it, especially in the middle and lower classes. US high yield credit spreads, these are low still. So again, if we start to see them spike, that is a bond concern. That's when the markets generally fall. But for now, I think this is still probably one of the best narratives, and that is the 1998 to 2025 kind of narrative. So effectively, if we're going to follow a very similar trend, at the moment, I've used this now for quite a while. You guys would know if you've been watching for ages. I've been big on the 98 narrative since 2024. And that effectively is that we're kind of going 97, 98, 99 into some kind of .com style ultimate AI crash. Not that AI isn't the future. The internet was the future too. It's just that it will push people in. And if this is going to be true, then we may not actually see a real vol period until January 2026. Now, what are we seeing right now? It's exactly the same as what happened last time. It's a pit. So at the moment, the market has been a little bit volatile in mostly tech, and you'll see that show up in the charts later on today's video. But the big thing here is that we kind of estimated that around this point, based on previous breadth thrusts, that we would get a rotation. So remember, guys, we come from the idea of abundance in markets. There's always another opportunity. And recently we've seen pickups in other market sectors that aren't momentum. And I've actually got a chart later on today's video that will show you when probably momentum comes back into it. But you can also see here that one of the reasons why this might happen like this is actually to do with the Federal Reserve itself. Remember, it's kind of like, every time something goes bad, the Fed comes out or somebody comes out, the government comes out, and they try to fix the system by, basically putting a bandage on it. Well, it's the same thing here. If we do get a similar to 98 rate cut or similar to 2024 rate cut, then we may see the markets initially kind of go, whoops, that's not so good, and then rally back up. And this is, of course, FundStrat's theory on it. I tend to agree, although it's what comes up will be the key. Remember, if IWM, so that is the Russell 2000, and mid caps start to outperform large caps during this rally that may come through, that is an overall structural concern. It's very bad. So actually, that is what we're going to be watching more than anything else. So what's going to happen in September? Well, it's historically weak. It's historically that market that kind of goes up, down, and all around. But will this year be any different? I still think it's going to be quite volatile. So stay tuned for that, and we'll continue to track it. Let's now take a look here at what's going on in the cryptoverse. So of course, the drop. We've talked about this a lot during cycle periods. Very common to see a drop around this period in time. Often Bitcoin underperforms, the mid caps overperform, which is of course what's happening at the moment. Large caps and Ethereum have done better in holding. And then if we do see Bitcoin then raise back up, which I expect it to do so and reach all-time highs this year, ideally, by at least maybe November, December, then we could see that alt market. And I think this really points back to that idea that if everybody is not all in, then it's very difficult to crash a market. And we just haven't seen the alts come through in the cryptoverse. So I guess that's kind of like, one of the things that's really holding this market together as well. Now, if you take post-election years and you consider where we are right now coming into September, it would make sense that volatility is on the horizon. You can see here that often the market kind of goes sideways. This time is, of course, maybe a little bit different. This is a 98-year whole history. So it's not that I don't think we're going to get a pit that is high, low, all over the place kind of market rotation. But at the same time, we will then get Fed support most likely. And usually about a month after the Fed support, markets tend to start rallying again. It's just what does it come with? Is it going to be, the mid caps, the small caps for 3 months, or is it going to be the large caps again ruling the roost? Well, let's now jump into the charts. Then we'll go to the options flow. Then we'll go to the lead indicators. First up, S&P. First bull hold, pretty strong. Obviously bouncing up with those wicks. You can see here going to that all-time high. And here is the futures market. They're the updated options flow levels, or the options levels for non-farm payrolls, by the way, guys. But yeah, as we mentioned in the previous video, it's very difficult to see a market selling off when you've got all these wicks. Take a look at these daily wicks here for a second. It just comes down instantly, gets a wick. So what that tells us that in the future, if we take out 63.50, that's probably going to bring momentum back down to 6,200. If we take 6,200, that would be a pretty big blow to the market. We'll have to talk about that if it does happen. But for now, this is what we call a dull market. Very slow. And when that's happening, it's one of those markets that a lot of people try to short. It's not easy to short. They have to have a saying, don't short a dull market. And one of the reasons why that is because, of course, while it's dull, it's generally rotating. When that rotation then turns into, okay, let's pick up the momentum again, it can go ballistic. So for now, we've got a pit, which is basically this market is just kind of sidewaysing all the way from August. It isn't actually doing as much as people think, and we are paying a lot of attention to the options walls in particular. So let's have a look at those. 6,500 is the call wall. We're right on it as of the close. So this basically means that if we start to move higher, thanks to non-farm payrolls, probably not the number. I mean, it could be a really bad number and the markets could still rally off it because, that's the type of market we're in. Bad news is good news kind of market. That's very customary of an end cycle style run, by the way, bull cycle, late bull cycle style run. And 6,500 plus close would bring us into positive gamma. Now, we failed to keep negative gamma this week because we failed to close below 6,400 properly. And this, of course, was what we've been talking about in this shorter week, which was that we couldn't get below that level. 6,400 is going to be where the bears start to push in. Of course, 6,350 on the charts themselves and 6,500 plus closure next 24 hours. That could bring further gains over the next week. And I know that may seem unrealistic to some people, but it is what it is. If markets break these zones, they often end up needing to be hedged, and that pushes the markets higher. Let's have a look at Tesla now. It's 350 on the call side and 320 on the put side. No change there. Did bounce off the put side last couple of sessions. And Nvidia still stuck between the 170 zone and the 185 zone. So again, Nvidia's weaker, and that's telling you exactly what we've been seeing. Rotation, rotation, rotation. So let's speak about that with this chart here, which is NASDAQ versus SPY. So basically, NASDAQ has weakened. We knew that. We see it in a chart that we'll talk about in a moment. And then, of course, we have a low, a lower high, a lower low. We may potentially get a higher high in the future. And that could change momentum back into, okay, tech stocks are back on. But for now, you can see it hasn't been that way. And if you actually go back through, there are excellent periods for these charts. I mean, you can probably see this one straight away, anyone that's on technical analyst kind of levels. And you can see here that as of, kind of May, it's really been all about momentum until this point here in August. So things changed. And one of the charts that we specifically looked at has been this one, which is still a very good chart. And you can see again, look at that date. The date is very similar. And this was the top 10 stocks that took us all the way to the rally. And again, we're in consolidation right now. So we're waiting for signs, whether they're coming back or whether they're going to keep, falling off. This is really the chart to watch for momentum. A lot of you guys just like semiconductors and tech stocks. So you'll be watching these charts very closely. Here's one as well, gap down on semis for SPY, kind of couple of days sitting around this support zone. If that drops, then that, of course, is going to be quite negative for markets. But for now, it's just kind of in a pit. It's going sideways. No signs of it weakened yet in terms of enough to see a real proper sell. Russell 2000 versus SPY, again, holding its own. That's rotation playing out. Russell is beating the SPY over the last month. And the yields. Now, this is an interesting one. You can see here it's expected, or at least the market's starting to think about yields dropping off a cliff because jobs numbers are going to be weaker. And the Fed went from a dual mandate, we care about inflation, we care about jobs, to stuff inflation, don't worry about that. We now only care about the jobs numbers. We need to fix the jobs numbers. So because of that, it's expected that the Fed will cut and cut several times now into 2026. And this is, of course, a concern long-term on the macro side, but for short-term, it can be quite bullish. So this will be one of those charts that a lot of people are watching, 3.6 or 3.5, the level to watch. And you can see here the previous lows here, 3.54 kind of area. So again, if it falls through, the markets may say, well, that's awesome for now. Continue the rotation switch into businesses that literally don't make any money. All right, let's have a look at gold. As we mentioned, we do like gold from the symmetrical side breakout. It hit kind of a new high. Obviously, everyone's talking about it again. Hopefully, you guys did all right. I saw some of you going absolutely ballistic in the comments section, so well done to you if you've done well there. But the main thing here is that the trend is still up. I think for short term, really like kind of those day trader kind of people, maybe we've hit a temporary top for now. Jobs numbers, though, could certainly push this higher as well, especially if we do see rate cuts. A lot of people don't realize gold's currency. If the interest rates do drop, unless it's stagflation, that's actually pretty good. So obviously, stagflation is good for gold, and rate cuts is actually good for gold. So again, I'm not bearish on that chart, but I think maybe we're in a slight, rest after a nice big move. Similar to silver, you can see here the trend is still up. Weekly close will be key there. And energy sector is holding its own in stocks. So you can see it had that little breakout back last week, and now it's back around this level. So I'm looking towards bids on energy, but the jobs numbers may push the actual oil market. We'll look at that on our special on the weekend. Nvidia still holding. The support is held, no breakdown. So theoretically, this is where the bulls are trying to pick it up. And you can kind of see here a bit of volume coming through after earnings. So very critical level for semis and Nvidia. And Tesla sitting in the middle, dojiing around this level, waiting to see its next move. Does it break 320 and get really weak? Or does it break 350 and push that 380, 400 narrative? Don't know yet, but that'll be interesting. And China's volatility has started spiking, but I'm not concerned about this yet. Actually, finding some support here on the daily 20. So we'll update that when needed. RSP equal weight outperforming. Again, it's good to see, some other markets or other sectors kind of join the breadth. So that's, of course, a good sign here for the US economy for now. And US 2K, again, almost a new high here. So people that are bullish on that, they'll be looking for 24.40. What could really throw a spanner in this work? Well, it could be the way the market reacts to the non-farm payrolls more than anything else. And we, of course, will track that through the weekend, guys. So make sure to follow for that one. Now we've got Solana. You can see here Solana holding up pretty well. Ethereum has held up pretty well. So you can see it's just kind of sideways waiting for the next big move. And NASDAQ is right at that point. In fact, I'll bring this up here just so you can see it. So this resistance here, it's a critical point because all of a sudden, okay, we're back on some bullish movement here. We've seen the wick purchasing of 23K. Obviously, we know that 22.7 is going to be a massive support in the future. If it does break, that will be a real weakness in the markets. But where is it? It's at a critical point ahead of the jobs numbers, and that's often what the markets will do. Bitcoin, main key level to look at, is probably 113, 104, and 98. And I'd like to see 104 or 98 to get a nice dip, but it may not do that. It may just break 113.5, and then all of a sudden we're back in. Okay, well, Bitcoin's going to probably be finding some momentum. So for now, the charts are all kind of sitting around key zones. Probably the big one that I've left off, but I'll bring it on for now, is this, the US dollar. It is super coiled. Take a look here, 97.6, 98.6. It is coiling in that zone. So it's probably going to have a fairly large move on it over the next 24 hours. And that may tell us a little bit more about actually the direction in markets. If you enjoyed today's video, then remember to subscribe, guys. Remember, 8:30 a.m. is the jobs numbers. So that's the point to be watching. I don't know if you even want to be paying too much attention to the number themselves, but instead pay attention to the flow. Do what they do, not what they say. All right, guys, thank you so much. Follow us on X. Follow me on LinkedIn, Thomas Atkinson. And also, if you're interested in finding out more about how we pick gold, silver, Bitcoin, other things, it's all down to cycles, repeatable processes, and more importantly, having a consistent plan. Check out our advanced course in particular, and I think you'll very much enjoy it. Bye for now. Catch you guys.